The dollar is often described as the most powerful currency in the world. It's used as a global reserve currency for international transactions, holds the largest share of foreign exchange reserves worldwide, and more than 60 countries peg their currency to the US dollar. So it's safe to say that the greenback is quite a force to be reckoned with. But what many people don't realize is that it's not actually all that strong. In fact, if you look at just how much the dollar has fallen over the past few decades, you might think that it's completely worthless. That's why you've been hearing so much chatter lately about the collapse of the dollar. But is this really something to worry about? Well, not necessarily. That's because the health of a currency isn't defined by its value. Let me explain. Hello and welcome to this channel where you'll always find something that improves your financial well-being. And today, we're tackling one of the most frequently asked questions here. Is the dollar dying? Or to put it another way, what determines the strength of a currency? Before we can answer whether or not the US dollar is dying, we need to first understand what makes a currency strong to begin with. After all, there's a reason why the dollar is considered the global reserve currency. For starters, the US is the largest economy in the world, producing around $23 trillion worth of goods and services annually. This means there's a lot of demand for the dollar since a lot of trade is conducted in the United States and with the United States. In addition, the US has a highly developed and efficient financial market that makes it easy for investors to convert their money into dollars, which contributes to the high liquidity of the greenback. The fact that the United States produces a lot of goods and services also gives it a current account surplus, meaning the country is generally able to finance more imports than it does exports. This means that there's typically a high demand for dollars from other countries who want to buy American products, further increasing the value of the currency. Finally, the political stability of the country plays a huge role in maintaining the strength of the dollar. With a long history of democracy, rule of law and property rights, investors are confident that their dollar holdings will be safe in the United States. Even during times of economic uncertainty, investors still see the US dollar as a relatively safe investment compared to other currencies. But despite all these benefits, the dollar has been on a steady decline for some time now. In the 1970s, for example, it took around $360 to buy 1 ounce of gold. Today, however, it takes nearly $600 just to purchase 3/4 of an ounce. So clearly something has changed. But before we dive into exactly what's going on, let me first explain why the dollar might seem weaker than ever right now. One of the main reasons the US dollar appears so weak is because of inflation. You see, since 1971, the United States has no longer been on the gold standard, meaning the value of the dollar is no longer tied to any physical commodity. Instead, it's what's known as a fiat currency, which means it derives its value from the government that issued it. Now, there's nothing inherently wrong with the fiat currency, but it does mean that the value of the dollar can be manipulated by the government through monetary policy. In fact, one of the main responsibilities of the Federal Reserve is to control the supply of money in the US economy in order to maintain price stability. However, when the Fed prints too much money, it can lead to inflation, which is exactly what's happened in the United States. From 1945 to 1971, for example, the value of the dollar remained fairly stable because the Fed was careful not to print too much money. However, after the United States ended the gold standard in 1971, inflation became a much bigger problem. By 1980, the dollar had already lost more than half of its purchasing power. Fortunately, the Fed was able to get inflation under control in the early 1980s thanks to the efforts of then Fed Chairman Paul Volcker, who raised interest rates to nearly 20% in order to curb spending and bring down inflation. However, this high inflationary period spooked investors, leading them to seek out alternative investments outside of the dollar. Since then, the value of the dollar has continued to fall against most other major currencies, including the British pound, euro and yen. But wait a second, didn't I just say that the value of the dollar is determined by the government? How could investors cause it to fluctuate so much if they're not the ones in control of the currency supply? Well, the thing is that while the Fed does have a big influence on the value of the dollar, it doesn't have complete control. That's because the value of the dollar is also determined by market forces such as supply and demand. In other words, whenever there's a lot of demand for the dollar, its value increases. But whenever investors lose confidence in the currency, it can quickly lose value. Take the Japanese yen, for example, which has recently hit a 24-year low against the US dollar. One of the main reasons for this is because Japan has maintained a loose monetary policy in recent years, keeping interest rates extremely low in order to stimulate the economy. As a result, the yen has lost more than 20% of its value against the dollar since 2020. Similarly, the euro has also fallen in value against the dollar in recent months due to the European Central Bank's slower than expected rate hikes. Now, you might be thinking, why do interest rates affect the value of a currency so much? And the answer is simple: foreign investment. When a central bank raises interest rates, it makes it more attractive for foreign investors to hold that currency since they can earn a higher return on their investment. This increased demand for the currency then drives up its value. Conversely, when a central bank lowers interest rates, it makes the currency less attractive to foreign investors, leading to a decrease in its value. But it's not just interest rates that can affect the value of a currency. Government policies can also play a big role. For example, if a government increases tariffs on imported goods, it can make the currency stronger since it reduces the demand for foreign currencies needed to purchase those goods. On the flip side, if a government decreases regulations, it can make the currency weaker since it increases the demand for foreign currencies. In addition, a country's economic growth also affects the value of its currency. If a country's economy is growing faster than the rest of the world, its currency will likely appreciate as well, since it indicates that the country is becoming more prosperous and attractive to foreign investors. On the other hand, if a country's economy is lagging behind, its currency will likely depreciate in value. So now that we know what factors determine the strength of a currency, let's take a look at the United States to see if the dollar is actually getting weaker. Well, it depends on how you define weaker. On the one hand, the dollar has been losing value against most other major currencies. This is because the Federal Reserve has maintained a loose monetary policy in recent years in order to stimulate the economy following the Great Recession. However, this has led to a sharp increase in inflation in the United States, which has eroded the purchasing power of the dollar. In fact, inflation has reached levels not seen since 1982. But this doesn't tell the whole story. That's because it's not just the United States dealing with high inflation. In fact, nearly every country in the world is experiencing it, thanks to pent-up demand from the pandemic, supply chain bottlenecks and Russia's invasion of Ukraine. As a result, the dollar hasn't actually weakened all that much against a basket of foreign currencies. In fact, it's only down about 5% since 2020. Meanwhile, currencies like the British pound and euro have actually appreciated in value. Of course, this doesn't mean that the dollar has strengthened, but it does mean that it hasn't weakened nearly as much as some people claim. But what about the future of the dollar? Will it continue to lose value, or is it poised for a comeback? Well, that's impossible to say for sure, but it does look like the Fed is finally taking steps to get inflation under control. In March, for example, the Fed raised interest rates for the first time since 2018 and signaled that more hikes were coming. This should help to stabilize the value of the dollar and prevent it from losing too much value. Additionally, if the Fed is successful in bringing down inflation, it could even boost the value of the dollar. Of course, this is easier said than done, and there are a lot of risks involved. If the Fed raises interest rates too much or too quickly, it could throw the economy into a recession. And if inflation doesn't come down, the dollar could continue to lose value. Only time will tell how things will play out. In the meantime, though, it's important not to panic. Just because the dollar has lost some of its value doesn't mean it's on the verge of collapse. In fact, a weaker dollar can actually be a good thing for the US economy. That's because it makes exports more competitive and encourages foreign investment. So, while it's true that the dollar has lost some of its value in recent years, it's not really as weak as some people claim. In fact, it's still one of the most powerful currencies in the world, and the best option for most people looking to save or invest their money. Thank you for watching. If you enjoyed this video, be sure to leave us a thumbs up and subscribe for more great content that improves your financial well-being. We hope you're enjoying this content, and we hope you continue to do so in the future.